Welcome back to the deep dive. Okay, let's unpack this. Today, we're diving deep into the world of investment strategy, especially how to navigate those choppy waters when a market feels, well, unpredictable. Our goal for this deep dive is to show you how to build a portfolio that can truly withstand uncertainty, give you some peace of mind, and maybe a clearer path towards your financial goals.
Exactly. And our source for this is really excellent. It's the May 2025 Financial Insights newsletter. It's authored by Genti, Cici, who's both a CFP and a CAIA. And this newsletter, it's dated May 7, 2025, and it really lays out a solid framework for investment strategy. It gives a clear rationale for smart investing, especially now.
Yeah, volatile times.
Right. It's a really pragmatic roadmap. It helps understand why discipline isn't just like a good idea. It's essential.
That's a powerful point, and I think a lot of you listening probably feel that need for a clear path through all the noise. So our mission here is to pull out the most important nuggets from Genti's Cici's perspective, give you a shortcut kind of to understanding a resilient long-term approach to investing. We'll look at why patience and careful planning are really your best allies here.
Yeah.
How you can position yourself for success, whatever the market's doing. So let's get into it.
Okay, so to set the scene properly, let's just think back a bit to April 2025. The market sentiment then was pretty agitated, right? Lots of noise around tariffs, announcements, unpredictability. Well, it was a lot.
Oh, definitely. A very noisy period for investors.
Yeah. But then moving into May, the newsletter points out some of that noise started to die down a bit. Maybe whispers of trade deals, a more tempered tone from the administration. There's maybe a slight exhale, but that uncertainty, it hadn't really gone away. And what's fascinating, and the newsletter really hammers this home, is that the advice during these times, whether it's super noisy or quieting down, is consistent. It's patience. And being really cautious about making changes just because you're scared or panicked.
The panic button.
Exactly. It emphasizes this crucial point. It's precisely during these uncertain times that investors often make that costly mistake, changing their portfolio without a real plan for what's next. That knee-jerk reaction without a strategy, that can hurt your long-term returns way more than the market dip itself.
Okay, so if the market's noisy and reacting is often bad, how do you cut through it? The newsletter talks about having a plan. And it mentions something called the core satellite approach. What exactly is that? How does it bring stability when things feel, well, unstable?
Right, the core satellite model. It's really built on a core belief, and it's backed by a lot of long-term data. And this data, it consistently shows that active investing, trying to pick stocks and bonds, trading frequently, it actually tends to underperform a simpler strategy, just following the overall market index.
That does challenge what a lot of people think, doesn't it? Yeah. The idea you need to be actively picking winners.
It really does. Many people feel like they have to be doing something, picking those winners constantly to get ahead.
This next bit in the newsletter, it really made me pause. Because the evidence it presents, it's not just like interesting. It really challenges a lot of the common wisdom. Data from multiple places, especially SPI by S&P Global. They track active funds versus benchmarks really rigorously. It shows that over time, active investing very, very rarely beats a simple indexing strategy consistently. It's just the data.
And here's a statistic from the newsletter that's, pretty stark. Over the last 15 years, get this, only about 10% of large cap fund managers actually beat their benchmark index. And even then, it's often not by much.
Only 10%. Wow.
Yeah. But here's the kicker, the really crucial point. Identifying that 10% in advance, it's incredibly difficult, almost impossible, some would say. And even if you luck out and find one for a period, the chance they'll keep outperforming. Quarter after quarter, year after year, highly unlikely. Beating the market consistently is just really hard.
Okay, hold on. Think about that. We're often sold this idea that investing success is about finding that hidden gem, that brilliant manager. But this data is saying almost the opposite. By not trying to pick winners, by just tracking the whole market, you're statistically doing better than 90% of the people who are trying. That's powerful. It's almost counterintuitive, like less is more in a way.
That's the beauty of it, really. So this index following approach, that typically forms the core of the portfolios discussed. It often makes up, say, 75, 85% of the total money invested. This core gives you that strong, reliable foundation. It puts you right in that top tier of performance just by capturing the market's overall growth. Without all the stress and, frankly, the low odds of trying to constantly pick the few consistent winners, it's about letting the market work for you.
Okay, so that's the core. Solid foundation, tracks the market. But the strategy isn't just the core, right? The newsletter says we can enhance results using satellites. What are those? Sounds interesting.
Exactly. So the satellites are smaller parts of the portfolio, smaller than the core. They're designed to complement that core, adding specific return or risk characteristics. They aren't random additions, they're strategic.
Strategic how? What do they actually do?
Well, the key benefits are they can potentially improve overall performance. They can enhance diversification because they might include things that behave differently than the main market index. And sometimes they can even help reduce the portfolio's total risk. They basically fine-tune the whole strategy, add some nuance.
And what kind of things are we talking about for these satellites? Like specific examples?
Sure. They could include things like ETFs, exchange-traded funds, maybe focused on a specific sector like technology or healthcare, or sometimes even individual stocks, if that aligns with the goals. The key thing here is that this part is highly tailored. It really depends on your needs as the client, your time horizon, how much risk you're comfortable with.
So this is where the personalization really kicks in.
Absolutely. That's a huge strength of the core satellite setup. It lets us weave in a client's specific interests. Maybe you really believe in a certain company or a theme like renewable energy. Or perhaps the advisor has a strong conviction about a particular area. We can express those views through the satellites while still keeping that robust, evidence-backed core nice and steady. It blends the data with the personal goals.
Okay, that makes sense. You've got the reliable engine in the core and the satellites for specific tuning. So with a solid strategy like that in place, it leads to the next question. What else does a really good advisor bring? It can't just be about setting up the portfolio and walking away, right?
Yeah.
Especially when things get rocky. What's that extra value?
That's such a crucial point. A skilled advisor adds tremendous value by making sure clients actually stick to the plan. You can have the best financial and investment plan in the world, but it's useless if you abandon it when things get scary, like, during a tariff scare or an economic dip.
Right, when your gut is screaming sell.
Precisely. It's so easy to get spooked by the news, by the noise, and just panic. A good advisor is that steady hand, helping you stick to the path you both agreed on, the long-term path.
It's wild how our instincts can betray us in investing. A robust plan, like the newsletter says, should really think about different possibilities, good, bad, totally unexpected. And often the guidance isn't some complex maneuver, it's simply patience. Let the market do its thing. It's about building that resilience in from the start.
And this leads right into the behavioral support an advisor provides, which is huge. They spend time explaining what's happening in the markets, putting it in historical context, explaining how returns are actually made. Because there's this common error, often subconscious, where people end up trying to buy high and sell low.
The opposite of what you should do.
Exactly. But people chase returns. They buy when things feel good and high, then they panic during a downturn and sell, locking in those losses. It's emotional.
Yeah, that instinct. When the market's dropping and everything inside you said, get out, stop the pain. That's often the absolute worst moment to sell. Feels right, but the data says otherwise.
It really does. The newsletter points out that trying to time the market, trying to sidestep the bad days, means you often end up missing the best days. And those best days, they frequently happen right in the middle of a crisis or just after one.
Like trying to dodge raindrops and missing the sunshine right after.
That's a great analogy. If you're sitting on the sidelines during those crucial recovery days, you miss a massive chunk of the rebound. You can really damage your long-term results.
Okay, so what does this mean when a crisis does hit? Instead of despair, it's an opportunity.
Potentially, yes. You can flip the script. For a prudent investor, a crisis can be a chance to deploy extra cash, maybe capitalize on those market dislocations, buy good companies or industries that have been unfairly beaten down, get them at a discount, or even simpler, if you're not looking to trade actively, you can just hold steady. Trust the plan. Let the short-term storm pass. It's about perspective and discipline.
Having the plan gives you the confidence to do that, I suppose.
It does, and that long-term history gives reassurance too. Over the long run, the market has always come back, always reached new highs. Sometimes it takes a year, sometimes two, maybe longer. But remembering that history is vital when you're in the thick of uncertainty, it reminds you that volatility is, well, normal. It's part of the deal for market growth.
And that's where the advisor becomes so important, right?
Yeah.
That calm voice.
Absolutely essential. During those times, having someone informed, objective, providing that education, that context, that rational guidance when your emotions are screaming, it's invaluable.
Keeps you grounded.
It keeps you grounded, and it fosters discipline. By guiding clients through those moments of panic or even irrational exuberance on the upside, an advisor helps build that crucial discipline. And just like clients get rewarded with better returns for not making impulsive moves, the advisor's role is to help make that happen. A plan that's been discussed thoroughly that anticipates different scenarios. It prepares you mentally. You understand market bumps are normal. They're kind of the price you pay for getting those strong long-term returns.
It really does circle back to patience, doesn't it?
Mm.
There's that famous Warren Buffett quote mentioned in the newsletter, too. The stock market is a device for transferring money from the impatient to the patient.
Yeah.
So true.
Couldn't have said it better. Timeless wisdom.
Okay, so let's quickly recap this deep dive for everyone listening. We've looked at the power of indexing, backed by solid evidence, within that core satellite framework, how it can put you ahead of most active managers. And we've really emphasized the huge role of behavioral discipline, how a solid plan and a good advisor help you maintain that, especially when markets get wild. We hope you'll reflect on these ideas, see how they might strengthen your own approach to investing, aim for that stability and long-term success.
And here's maybe a final thought. What's fascinating is if you're really aiming for that long-term financial success, maybe the most important active decision you make isn't trying to pick the next hot stock. Maybe it's actively choosing patience instead of panic, actively trusting your well-thought-out strategy instead of reacting to every headline. That's where the real active management might lie.
Choosing patience actively. I like that. A great thought to end on. Thank you for joining us on this deep dive into smart investing. We'll catch you next time.